For 76 years, there was one rule in German politics that nobody touched. Not the chancellor, not the opposition, not anyone. It was written into the constitution itself, the Grundgesetz, and it said, in essence, the German government is not allowed to borrow more than a sliver of its economy each year. 0.35% of GDP, that's it. That's the limit. Germans call it the Schuldenbremse, the debt brake. On March 21st, 2025, the German parliament voted to blow it up, €500 billion, roughly 12% of the entire German economy, unlocked in a single vote by a country that has spent 2 decades treating borrowing the way a recovering alcoholic treats a bar. Here's the cliffhanger this entire video is built around. Germany has spent the last 15 years being the reason the rest of Europe didn't collapse. Every time Greece, Italy, or Spain wobbled, global markets stayed calm because Germany was there, the fortress, the guarantee, the adult in the room. So what happens to that guarantee when the fortress itself starts borrowing at the highest rate it's seen in over a decade? That's not a hypothetical, it's already happening. And by the end of this video, you'll understand exactly why Germany felt it had no choice, and why the rest of the continent is holding its breath. To understand why Germany just did something this radical, you need to understand what made Germany different in the first place. Wolfsburg, Lower Saxony. This is the home of the largest car factory on the planet, the Volkswagen plant, where tens of thousands of workers and a forest of robotics produce close to 1 million vehicles a year. To put that in perspective, this single facility produces more cars annually than the entire United Kingdom. When most wealthy nations get rich, they do the same thing. They let manufacturing move overseas, and they pivot toward finance, services, and tech. That's the American story. That's the British story. Germany refused. Germany doubled down on making things, precision machinery, chemical products, cars. To this day, manufacturing makes up roughly 1/5 of the entire German economy, nearly double the share in the US or UK, and Germany remains one of the largest exporters on earth, year after year. For decades, this was a cheat code. German factories shipped out precision-engineered goods, and foreign money flowed back in, year after year, trade surplus after trade surplus. The country was, quite literally, making more than it was spending. And when a government is sitting on that kind of cash flow, it starts to develop a very particular kind of confidence. The confidence that says, we don't need to borrow, ever. We're different. In 2009, in the aftermath of the global financial crisis, Germany did something that looked at the time like remarkable discipline. It wrote a rule into its constitution, the Schuldenbremse, limiting new federal borrowing to 0.35% of GDP per year, with only narrow exceptions for emergencies. While other major economies were running up large deficits to recover from the crash, Germany essentially locked its own vault. And for a decade, it looked like genius. Between 2010 and 2019, German unemployment fell to some of its lowest levels in decades. The country ran enormous trade surpluses, hundreds of billions of euros a year. Berlin became the model student of the Eurozone, the country other governments were told to imitate. But there was a structural problem hiding underneath all that success, and it's the kind of problem that's invisible right up until the moment it isn't. Germany's entire model depended on 2 things working perfectly forever. First, that the rest of the world would keep buying German exports at scale. Second, that energy, the fuel that runs every blast furnace, every chemical plant, every factory line, would stay cheap. The debt brake meant Germany wasn't investing the surplus years into upgrading its own infrastructure. Roads, rail, digital networks, energy grids, all of it aged quietly in the background while the country congratulated itself on its balanced budget. Then came the shocks. Not 1, 2, back to back, each one landing on a wound the previous one had opened. 2020. The pandemic shuts down global trade almost overnight. For an economy that depends on selling things to the rest of the world, a global lockdown is close to an existential threat. German exports and industrial output dropped sharply. The economy contracted by roughly 4% that year, its worst year since the post-war period. In the United States, the government responded by unleashing trillions of dollars in stimulus. In Germany, the debt brake had to be formally suspended just to allow emergency pandemic spending, a sign of how rigid the rule had become. Then, 2022. Russia invades Ukraine. Before the war, Germany sourced roughly half of its natural gas imports from Russia, cheap, reliable pipeline gas that didn't just heat homes. It ran the blast furnaces. It boiled the chemical vats. It was the quiet, invisible subsidy underneath every Made in Germany label. Within months of the invasion, that pipeline gas was effectively gone. Energy prices across Germany spiked violently. Industrial electricity costs that had been predictable for decades suddenly weren't. Factories that had run continuously for generations started going quiet. The result was 2 consecutive years of economic contraction, 2023 and 2024, the first time Germany had shrunk for 2 years running since the early 2000s. Manufacturing output fell for 3 years straight. Industrial bankruptcies surged to their highest level in years. Volkswagen, the company in Wolfsburg, the literal heart of German manufacturing, announced plant closures and pay cuts for the first time in its history. On top of all of that, the new U.S. administration began threatening tariffs on European goods and pushing European NATO members, Germany included, to dramatically raise defense spending or risk losing American military backing. Every pillar of the German model, cheap energy, open export markets, American security guarantees, was shaking at the same time. So in March 2025, the outgoing German parliament, in one of its final acts before a new government took office, did something that would have been politically unthinkable just a few years earlier. It amended the Constitution. 2 changes. First, any defense spending above 1% of GDP would no longer count against the debt brake, effectively unlimited borrowing for the military at a moment when Germany is racing to meet NATO's higher spending targets. Second, a new €500 billion special fund sitting entirely outside the debt brake to be spent over 12 years. €100 billion goes to Germany's federal states. €100 billion is earmarked for climate and energy transformation. The remaining €300 billion goes toward federal infrastructure, transport, hospitals, energy grids, digital networks, research. And the infrastructure need is real. Germany's own transport ministry has flagged thousands of bridges nationwide as structurally compromised, some requiring weight restrictions or closure. Broadband coverage in large parts of the country has lagged well behind the rest of the European Union. The Autobahn, the symbol of German engineering pride, has visible cracks, literally. 20 years of fiscal discipline had quietly become 20 years of underinvestment. The bill for that came due all at once. Here's the strategy, in plain terms. Borrow heavily now. Use the money to fix energy infrastructure, transport, and digital networks. Bring energy costs back down. Get the factories humming again. And let future economic growth, and the tax revenue that comes with it, pay down the new debt over time. There's a historical precedent everyone keeps pointing to. Post-war Japan. Japan borrowed aggressively to rebuild roads, ports, and rail after World War II, and it powered years of extraordinary growth. But here's the catch, and it's a big one. Japan in the 1950s was building from literal rubble. Every road, every port, every factory was new. There was no old system to fight against, just empty space and opportunity. Germany in 2025 is not building from rubble. It's trying to retrofit a famously dense, bureaucratic system that has had 70 years to calcify. According to Germany's own central bank, the Bundesbank, much of this spending isn't expected to meaningfully boost growth until 2027 because of how long it takes major infrastructure projects to even get through planning and permitting in Germany. For decades, there's been an unwritten rule underneath the entire Eurozone. Whenever a weaker economy, Italy, Greece, Spain, gets close to the edge, global investors don't panic because everyone assumes that if things got bad enough, Germany's financial strength would ultimately backstop the whole system. Germany was the reason other countries could borrow cheaply too. Now Germany itself has become one of the biggest borrowers in Europe. Germany is on track to issue several €100 billion in new bonds in a single year to fund this spending, a scale of borrowing that would have been unimaginable under the old rules. And the market has noticed. German 10-year bond yields, the interest rate Germany pays to borrow, climbed toward their highest levels in well over a decade, brushing close to 3%, levels not seen since around 2011. Higher yields mean higher interest payments. Every percentage point increase on hundreds of billions of euros in new borrowing is real money. Tens of billions of euros a year in additional interest costs, money that doesn't build a single bridge or wind turbine, it just services debt. This is the contagion risk. Not that Germany goes bankrupt. Nobody serious thinks that's on the table. The risk is narrower and more insidious. If Germany's borrowing costs rise meaningfully, it changes the calculus for every other Eurozone country whose borrowing costs have been anchored in part to confidence in German fiscal strength. The safety net doesn't have to disappear. It just has to get a little less certain. And markets will reprice everything around that uncertainty in real time. So here's where Germany actually stands. A country that spent 15 years being praised for its discipline just admitted, in the most dramatic way possible, that the discipline had a cost measured in crumbling bridges, patchy broadband, and an economy that had become brittle precisely because it refused to bend. The 500 billion euro bet isn't reckless by accident. It's the result of a system that had no slack left for a double shock, a pandemic and an energy crisis, hitting back to back. Germany ran out of room to absorb shocks the old way, so it changed the rules instead. Whether this works depends on something that's genuinely uncertain. Can a famously slow, bureaucratic system move fast enough to turn 500 billion euros into lower energy costs and modern infrastructure before the bond markets lose patience? Here's what I want to know from you. Is this Germany doing what it should have done a decade ago, finally investing in itself? Or is this the moment the most disciplined economy in Europe starts looking like everyone else? Drop your answer in the comments. And if you want to see how this connects to what's happening with Russia's own war economy right now, that video is right here. One more thing before the end card. Watching a country like Germany have to rip up 20 years of financial rules in a single vote is a pretty good reminder that even the most safe financial plans can get upended by things you don't control. Energy shocks, wars, global shifts nobody saw coming. That's part of why I started building something of my own on the side. Income that isn't tied to one employer, one country's economy, or one government's rules. I learned how to do that through Wealthy Affiliate. It's a platform that teaches you, step by step, how to build an online business through content and affiliate commissions, the same model that supports this channel. No experience needed, and there's a free account to start with, no credit card required. If the idea of building income that doesn't depend on someone else's balance sheet sounds worth a look, the link's in the description.